Yeah, first of all, I'd like to thank you, O&M, for allowing me to hold forth here on an area that I know a lot about. Um, things have changed since the last time you guys interviewed me. Obviously, the credit bubble burst, and COVID was the trigger, but the problem was much more than just COVID. You've got a situation where there was too much debt relative to GDP, and it just couldn't go on forever. And at some point, it had to burst. We just didn't know when. And there's no doubt it has burst, and I don't think they can put the genie back in the bottle. Um, and so the implications for the investments that I do, and for probably a lot of the people who listen to this, are pretty profound, because the way gold markets behave is it's a bad area to be, 60, 70, 80% of the time, but it's an extraordinarily good area to be in certain environments, and the returns that can be earned in a relatively quick period of time are pretty substantial, as everybody finds a wrong-sided, and they need to go from where they are into what you've got. And that's kind of what we're seeing with the gold market and the gold share market right now. A lot of generalists and other people are waking up to the fact that the unprecedented monetary response to the bursting of the credit bubble, which was, shown in the plunge of the S&P and the Dow during the month of March. The Fed came in with kind of everything, including the kitchen sink, and importantly, it wasn't just like '08 where they filled in the balance sheets of the bankrupt or the troubled lenders, but they also started going direct, which is a term that's very important to understand. They sent a check to people, they sent money to businesses that they didn't have to pay back. I mean, they literally handed out money. The people, check to people, I thought was kind of almost insultingly small compared to what businesses got, but nevertheless, it opened the door to bigger checks in the future. And once the country starts printing money to send to people, it doesn't typically end well for the country's currency. And there are hundreds of examples of this over the history of civilization. So the implication from that, of course, is that you want a currency that can't be printed, and gold and silver qualify and have for 5,000 years. Bitcoin does to an extent, but it's got technical risk. And so it's, in my view, we're in a period here where people who own gold and silver and people who own gold and silver mining companies are going to make an extraordinary return in a very rapid period of time. And so, being in this area and well positioned in this area could be very rewarding if I'm correct. I always like to state the other side. The other side is that this is just a blip, that, we're going to have a fast recovery, a V-shaped recovery, that the Fed's got it all under control, and that we'll get another credit cycle going and everything will be fine. And so you don't need gold because it's not something that's important to you. Related to that, some people say, well, yeah, okay, we definitely, the credit bubble blew up, but we're going to have deflation, and gold isn't necessarily something you want to hold deflation. Everyone knows gold is an inflation trade, and that's true. It is an inflation trade, but it's also a deflation trade. It did extraordinarily well on a real basis in the 30s. The reason it's a deflation trade is that it can't go bankrupt, and if the price of everything else is falling relative to it, it's a very good investment. So if we truly have deflation, which I don't think we'll have for very long at all, I think we could have some CPI deflation for a few months, and we'll clearly get deflation in things like high-end homes and automobiles and luxury things. I think gold will be fine. I mean, the price may slow down in its rate of increase, but the real story is just the magnitude. I mean, in all of the QEs, QE 1, 2, and 3, the amount of money that they used or printed, so to speak, or I should say injected into the system, because they really plugged a hole, it was a swap into the banks, was in the $3.7 trillion range. I think it was about 3 trillion actually, roughly, and took them up to a balance of 3.7 trillion. And now what you've got is a case where we did all of that in months, and that and then some in months. I mean, the Fed balance sheet is now up over $7 trillion, and it was starting at 3.8 or so. So this is unprecedented, and nobody's really, there's no roadmap for how this unfolds. but I do know that from my point of view, I feel very comfortable being in silver and gold and silver and gold mining equities, because I think it's going to be a better place to protect capital during this part of the business and credit cycle. So that's kind of how I'm approaching it. You know, I've been doing this. I've been picking gold equity since 2008. It worked well for a few years, and then they managed to get another credit cycle going. It didn't work very well. You know, gold and the credit cycle are opposite sides of the same coin. When business is good and business is growing and everything's productive and people are going forward with a real economy, if there's not inflation, you really don't need gold. But when the converse of that happens, you know, the real economy suffers, earnings suffer, stocks suffer, debt collapses, and gold suddenly becomes extraordinarily important. And I think that's one of the things that's important to understand, is that if you look at the historical gold bull markets, they tend to really be dramatic. I mean, things don't go up, you know, 2x. They go up, you know, between 2 and 8x. And this is on the shares I'm talking about now. So, you know, it's an area where, you know, I think if I'm right, and I could be wrong, but if I'm right, the rewards are going to be, you know, it's going to happen faster, I should say, than, I mean, you multiplied your money in the FANGs or in other areas, but it took, you know, 10 or 15 years. I mean, I think this could all be over within a handful of years, maybe, you know, maybe even as short as a couple of years. So, you know, I can see a very good return in a relatively short period of time, you know, in part just because of the way the crisis is developing. I was looking at pictures of Minneapolis this morning, and, you know, it's horrible what's going on. But all of these things, in my mind, don't drive people to be more confident in the U.S. economy and the U.S. stock market. And, you know, they've got the market to recover by printing all this money, but I don't think this recovery lasts. I mean, I could see, you know, we're going to be back in a March-like period where it's going, the stock market's going down quickly. I mean, really, the whole thing in my mind, it kind of hangs on the confidence in the Fed, you know, and everyone, I mean, for 15 years, the Fed has had your back. And, you know, you bought every dip and it always worked. And even this time it's worked so far. But, you know, there's going to come a point in time, you know, the release valve in that Fed has your back is that eventually the amount of money they print just becomes so large that confidence is lost in the monetary medium, in the paper that they're printing. And when that happens, you know, it's all over. And, you know, I feel like we're getting fairly close to that happening. So, you know, I position myself accordingly. Yeah, thank you very much, guys, for having me on the program. I always enjoy talking to resource investors. I do have an email list that I put people on. I read a quarterly summary of what's going on. It's free, so I'm happy to do that. Anyone who sends me an email, I'll add them to the list. My email is my name. Well, it's LL, so 2 L's, and then my name, Lepard, Lepard. So Lepard at EMA, Edward Mark Alpha, the letters, the number 2.com. So EMA2.com. Send me an email, I'll add you to my list, and you can see my commentary, which I put out every quarter. So.